This week's market narrative is clear: event risk into Jackson Hole, then a repricing of the rate cut path after Chair Powell's remarks. Before the speech, front-end United States Treasury yields inched higher, the dollar held firm, and equities mostly consolidated. Afterward, Chair Powell emphasized rising risks of labor market cooling and noted that disinflation is uneven but manageable. The dollar weakened and risk assets recovered at the margin. United States data supported the idea that cuts are possible, but the pace matters. Hi, I am TQ. In this episode, let us unpack the logic behind the moves. Initial and continuing jobless claims for the week ended August 16th, both rose, signaling further labor market cooling. Meanwhile, July existing home sales rebounded, suggesting housing has not stalled. This mix does not argue for aggressive cuts, but it does leave room for at least one cut this year. Two things to watch in the coming week. First, a flurry of remarks from Federal Reserve officials. Will they walk back the market's dovish take? Second, the United States PCE release. If core PCE slows month over month and pulls real rates lower, risk appetite should improve. Bitcoin and Ether typically benefit through the liquidity and risk appetite channel and show greater upside elasticity on rebounds. If core PCE rises and lifts real rates, crypto would first feel pressure from tighter funding and a stronger dollar, with high beta segments pulling back faster. The macro to crypto transmission is fairly direct. Range bound into the event, firmer afterward. The core remains. Falling real rates plus a softer dollar lift risk appetite. Bitcoin maps more closely to digital gold and is most sensitive to real yields. Ether enjoys an ETF and ecosystem premium, but in the near term, it still trades with rates and the dollar. Across alternative coins and on-chain sectors, high beta names tend to bounce less. Layer 2 and infrastructure outperform pure narrative coins, and blue-chip DeFi is relatively resilient, but a lukewarm tape caps secondary volumes. The United States rapper Ye, also known as Kanye West, launching a token illustrates that related memes can ignite in the short term but fade quickly. That signals weak chase the rally appetite and a fragile bid structure. This aligns with our earlier view. Narrative-only assets are under pressure, while capital prefers higher quality infrastructure and DeFi blue chips, for example leading Ethereum DeFi and Layer 2 infrastructure. In the medium term, that is healthier. Liquidity first flows to segments with real demand and cash flow, volatility is more controllable, and pricing more efficient. On regulation, let us look at where the Genius Act stands now. On August 18th, the United States Treasury published a request for comment, opening a public comment window. This signals the stablecoin framework moving from statute toward executable supervisory code. The request for comment is the pre-implementation stage where regulators solicit evidence and proposals before drafting final rules. Why is this the choke point? First, it is the most malleable window. Once you reach a notice of proposed rulemaking with anchored text, the scope to adjust shrinks. Second, definitions set economics. Reserve rules, service-level agreements, and audit frequency determine spreads, liquidity buffers, and operating costs. Third, the map is redrawn. Federal, state, and offshore comparability and scale thresholds decide who can operate nationally and who must upgrade licenses. Fourth, bank participation and market depth hinge on guidance for custody, master accounts, capital, and liquidity. This sets the friction for banks and the speed of institutional and cross-border adoption. Net, this stage sets the cost function to enter stablecoins. How much cash and treasuries you must hold, how frequently you disclose, how fast you settle, and how deep you go on compliance. All of that ultimately becomes long-cycle fixed basis points plus variable costs in stress. Now a quick timeline review for ETH ETF staking. Grayscale and Bitwise. Grayscale's spot Ether ETF staking amendment was posted on March 3rd. On May 28th, the SEC instituted proceedings, opening comment and rebuttal. On the statutory clock, the outside date is around October 29th. That makes September to October the key observation window. Bitwise's spot Ether ETF was published on April 7th and entered proceedings around late June or early July with comment windows. The outside date is around December 3rd. The SEC can act early, either approve or deny, or issuers can withdraw and refile, which resets the clock. At the current cadence, September to October is the focal period for staking policy risk. Now to ETF flows last week. Flows shifted from prior Ether-led inflows to net outflows in both Bitcoin and Ether last week. Funding flipped quickly, leadership paused, and we entered a macro-led repricing window. For Bitcoin, the prior week showed an inflow of about 4,520 Bitcoin, which turned into net redemptions of about 1,250 Bitcoin last week. That is a swing of about 14,770 Bitcoin. Funding flipped from absorbing new supply to releasing it, creating near-term price pressure. If Bitcoin ETFs reclaim and hold a positive weekly inflow threshold, the trend can repair quickly. If redemptions persist, or creations cannot get back above about 3,000 Bitcoin per week, then pullback and consolidation risks rise. Ether showed relative resilience. About $1.07 billion of Bitcoin net redemptions versus about $700 million for Ether, about 1.6 to 1.7 times. That suggests capital exited Bitcoin first while keeping a wait-and-see stance on Ether. If flows repair, it likely shows up in Ether first. That is it for today. Next episode, we will cover Layer 2 under current conditions and what could change as Ethereum Layer 1 embraces native rollups and zero-knowledge technology. Leave a comment and let us discuss. I am TQ. See you next time.